Welcome to this month's Q&A show. Cam McClellan have with me, as usual, Matt Lewison. Matt, how are you?
Yeah, good. Thanks, Cam. How you doing?
Good. And Matt's older brother, Al. How's it going, Al?
Everyone, how are you all? G'day, Cam, Matt, Christian.
Got a special guest, Christian Patterson's a operations manager at Open Finance. We thought finance is a really good topic to delve into. We're going to go through a lot of things today. Christian, how are you?
Hey guys, excited to be here. Fantastic.
Christian, where are you located? Looks like you're in a recording studio. I know you've done a bit of DJing and rap in your younger days. Were you what was it, LA Beat Street, Backstreet champion back in the day? Is that right?
Yeah, that was a past life. Guys. But yeah, I'm here on beautiful Sunshine Coast in Queensland and enjoying the weather. Beautiful sunny day outside here. I think it's 27 degrees and blue skies, so we can't complain.
Sounds terrible.
Tough. We're in Melbourne, but no, it's all right. We'll challenge you. We're mid-20s today, so all good.
Oh, Cam, you look like you're in a recording studio. Is that what you want us to say?
Yeah, no, this actually doesn't work. It's just for looks.
Looks really good.
Yeah, fantastic. We'll gibber on a little bit just to make sure people are on, and then the questions will start flowing through. But what's happening? Melbourne started to kick again, and Al, you've been talking to people in Brisbane most recently. What's happening? Word on the street in the property world?
I think Melbourne and Brisbane. Probably Melbourne. I guess I'll talk about first because I've just come off back of a phone call with a couple of agents tonight, and they're run off their feet. I think the moment that Dan Andrews said, "All right, we can start opening up again," immediately. One agent said, I think he had 30 inquiries to walk through a property the next day. He said he had to start pre-conditioning or pre-approving people almost to make sure they weren't just tire kicking and bored of being at home and really wanted to buy a property. So they started, I guess, putting some steps in place to make sure they weren't wasting their time. But I think every real estate agent in Melbourne is pretty adamant that this is about the busiest they've ever been. And we talked about it, last show. And a lot of that is, I guess, ordinarily in every month of every year, people are moving house and buying houses. And we have these 7 months where Melburnians were locked away. So there's sort of a bit of catch-up going on. Everyone's out in the market. And agents are certainly struggling to find listings to keep their stock rolling through. So they're up and about, and the activity certainly on a rampage in Melbourne at the moment. And Brisbane, Matt will talk about, I think, the land in new estates and what the government grants have done there, but absolutely similar feedback. I think for a little while up there, they've had this rippling going on closer to the city, inner suburbs, and that's now filtering itself out, with the ripple effect that we talk about so often. So they're starting to feel it right across the market. And again, absolute shortage of stock, shortage of listings, lots of people turning up to try and inspect and buy. So agents certainly around the country are very happy at the moment.
Yeah, very nice. I mean, Matt, I'm sure is going to go into the depths of analytics as the night progresses, and we love that because he's got access to that with the internal and external research teams that he drags the data together. But I often find that Al's pretty good sounding board talking to agents daily through a number of different markets. So you get that real raw boots on the ground as well as the deeper detail from Matt and his acquisition team. But Christian, whereabouts on the sunny coast are you?
At the moment, I'm in Sibby Downs, so not too far from Mooloolaba. So it's nice and pretty down here. The Sunshine Coast is going gangbusters from all reports that I've heard around the area as well.
Yeah, I know Tim Lawless from RP Data's lives in Noosa, so he's been enjoying, while the rest of Australia's been locked away. His morning strolls are pretty nice, I assume, with no tourists in there.
And there's a lot of that, the migration, as people are moving out of Melbourne. Why wouldn't you choose the Sunshine Coast, I guess? I guess it probably depends on time of life, the people that are migrating. And again, Matt might talk about the migration numbers that are happening, but certainly it'd be appealing if you're coming out of Melbourne and moving up there to land yourself somewhere like Christian has in the Sunshine Coast and enjoy the lifestyle that goes with it.
Yeah. Just while we're you're talking to agents and the ground in Melbourne, it's I know a few of them are hit pretty hard, and like yourself, Al, talking to agents daily. And a lot of them are spewing about the auction season. They're just not going to make that auction season this year. What strategies, guys, can people, if they're looking for a primary place of residence and they're getting out there and they don't obviously have not that auction need there, agents are going to try and draw on those closed offers. What other sales positioning tools have the agents got, and how can buyers overcome those if they're trying to get their own primary place of residence?
one of the best ones, and you used it, Cam, is to offer them an extra commission. Hey, if you can give me a foot in the door here, you can sell a property for me. So they go to work pretty hard. And I heard a story recently where very similar. Can you help me out? Help me buy one before auction? Can't help. I think I can do it. Well, actually, I've got a house I need to sell. Well, actually, I can actually put an offer in for you. Maybe we'll see how we go. So
Yeah,
that's a good way to do it.
It's the old 2 licks of the ice cream, isn't it? Was it 2014? We bought our house where we are currently, and it was going to auction the following weekend, and it was a hot market. I didn't want it to go to auction. I was happy to pay a pretty good dollar, but I wasn't sure what the top dollar would be. So exactly that. I remember going to the agent. If you can get me a contract tonight on this property, you can sign up my property. And they turned around. So you take that agent from working for the vendor 100% to working for you, probably a little bit more. So,
And I think it's also that fear of loss, isn't it? And although everybody says, I'm not going to be able to make it to your auction because I've got another one an hour earlier, so I'd like to put an offer before auction.
Yeah.
As an attempt to get that fear of loss that you won't be there and maybe you're the highest bidder. But
Well, that one on the week before, so I won't be at this one. So help me out. They've heard it all before.
Yeah.
Where's that property again? Oh, that one. Yeah, I know that one. That's completely different.
Yeah. The closed envelopes, just for selling, obviously, we want to make sure that our listeners get the best out of any information we've got. So people, obviously, if they're looking to buy a primary place of residence, they're also trying to sell a primary place of residence. I think one of the tactics the agents use very readily, and they'll probably be using it through this period of time. And agents, we're just trying to help you out and train the buyers and sellers of how to utilize you best. So don't feel offended with what we're going through at all. So we're trying to help everyone. But the closed envelope is obviously the classic one. But what Al and I use quite often when selling using a closed envelope system is to turn that into a mini auction. So, and to really, you get the closed envelopes in, they're all closed by 4 o'clock on whatever day. Go into the agent's office with them, sit there with them, open them up, and then make the agent call every person in a circular fashion and notch everyone up as much as they can until you start knocking people out. So you can create that auction, without the cost of an auction. You can jack that price up a little bit. So hopefully that gets a few people and a few extra bucks for Christmas.
Well, the really hard thing, right? If you're the seller versus the agent just wants a sale. If you get an extra 50 grand,
very true.
Nothing extra to him. He makes a little bit more, but it's not going to buy him a holiday. He wants that sale, and he'll happily bring the price down if it means getting a sale. So there's not that motivation there to bump it up because an extra 10 grand to him might mean $100. It's not a lot of money.
Half of an agent's job is to condition the seller, to make sure the seller doesn't just keep procrastinating, dragging it out and taking forever to sell. They're conditioning the seller to accept a price that they know is achievable, and they want it to turn over quickly.
They do a good job though. I mean, there's no way I'd try and sell a property myself and need to do the negotiation aspect. Like, it's fantastic having that person in the middle when you're selling that you can not push around, but you can direct and, help with the strategy of what's going back to the buyer.
Yeah. I was just going to say, I've been on the other end of a negotiation where it was a bit of a closed envelope type thing that came out of nowhere. It seemed like the property had been on the market for a long time, put in an offer. All of a sudden, there was another offer that had appeared out of nowhere.
Of course there was.
So the agent's calling and you're doing the back and forth. And even though I was well and truly trained to know there's a good chance that that's just a game that they're playing, you still, in a way, kind of still go along with it because you're like, I'm 90% sure it's a game, but I'm 10% uncertain. And if I really want this or not, then it can get more out of it.
Yeah, Felicity and I had talked about when we bought this place, and I just went in super hard just trying to pull it off the market, the price I needed to. So probably paid maybe 100 to 200 grand more than I could have. You always have that thought afterwards, but I don't really care now. The property's gone up millions of dollars more in the last 5 years. So, it is what it is. You cop it at the time.
Like a bad haircut, isn't it, Cam?
What it's all it's your dad's saying. I think it is originally. So,
I thought it was yours.
Actually, maybe it was too many beers one day. I actually remember when I told him that now, and I remember him laughing. So that's why I thought it was his. But yeah, so property's like a bad haircut. Time fixes everything.
Yeah, although your last bad haircut was about 10 years ago, it still hasn't recovered.
Yeah, I reckon. Look at that bad boy. That's tight, isn't it? That's tight.
Hey,
Hey, Chloe, thanks for joining us. Daniel, Nate, great to see you all. Don't be scared. Throw some questions around. More than happy to take them. We'll just keep rabbiting on. Can talk all day long. Matt's doing his hand up.
My auction paddle. Yeah.
That's right.
Just Al was talking before about the pent-up demand in the housing market, and I think it's probably something else that, again, we talk about some of the intangibles about what drives property markets. Confidence is such a huge thing. People being confident they're going to have a job or that their wages are going up, that sort of thing. And if you think about pent-up demand in the housing market, and then you apply the same to pretty much every facet of the economy right now. One of my neighbours owns a cafe in the southeastern suburbs of Melbourne. It's been pretty popular. I saw them after Melbourne Cup weekend. They'd served 3,000 meals. It was about 1,000 more than they'd ever served in 4 days. And they said people are just queuing up to get catch-ups with their friend. The courts are rushed off their feet at the moment. Tradies that you talk to are booked out. People just like falling over themselves to try and get work done. So at the moment, and if I bring this back to the housing market, particularly in Melbourne, at the moment, there's not a lot of good quality housing stock coming through the auction market. Because all the people who need to do a little bit of work to get their house ready for auction are going to wait until next year to put it on, probably late January, maybe in Feb, capture that autumn market. So at the moment, there's properties on the market. They're generally the people who have been rushed into selling. So they're probably more motivated vendors than you'll find early next year. So people who are in the market right now, there's a bit of competition. Early next year, there's going to be a heap of competition for good quality homes, and we're expecting to see really solid price growth in that early part of next year. So if you're trying to get into your PP, into a principal place of residence, now's the time to do it.
Nice.
So as we know, it's not the weather that drives the auction markets in Melbourne, it's the school year. People buying in September, October, hoping to settle by Jan, get the kids in a new school. So again, just I guess feet on the street, lots of agents have said that ordinarily, that January, back end of December and January is quiet. They're working through, they're taking main days, buyers are going to be around, and they expect to be completely active, getting people into short settlements, getting new properties ready for the school year. So I think, as you're saying, they're catching up and people are just tweaking what they do. Normally they work right through, take 4 weeks off. This year they've had a good holiday, sort of, and probably not good, but they've had a holiday. And they're going to use that period over Christmas to keep that school year cycle happening, which is so relevant.
Oh, true. Hey, Christian, give us a bit of background. I know you're doing a little bit of study at the moment. What are you smashing through at the moment? Give us a bit of background where you grew up, what your career progressions be, and then why you're trying to jam so much study into your working life as well.
So I'm a Brizzy boy, born and bred. So I recently just relocated from Melbourne. I was down in Melbourne for the last 6 years, and obviously I had some foresight that COVID was going to hit. So I relocated in December. So I've been enjoying the sunny coast. At the moment, I'm studying an MBA at USC here. So COVID hit, and I thought it'd be a good opportunity to upskill myself and learn a little bit about how to operate in a more futuristic fashion. I've been in finance, in mortgage broking I was looking at it just before, over 14 years. So it feels like forever.
Yeah.
It feels like forever. So been around, worked with agents, worked with accountants, worked with financial planners and investment groups similar to OpenCorp. So been around the block a few times.
Yeah, and you're doing triple subjects at the moment?
Yeah.
Is it?
Just trying to pump it out as much as possible and set myself up for a big 2021. I'm getting excited for the year ahead, and just I think, like everybody else, just trying to survive the next 6 weeks until Christmas.
Yeah, and obviously you've got a pretty sizable team at Open Finance, and you've got a nationwide team that you're managing. Your skill set in operations is obviously creating process within teams, and having an NBA or completing an NBA is obviously a good asset for us, and sets us in good stead. Obviously, with you coming on board and working with us this year and into the future, so it's exciting to have you. But talk us through some of the challenges that you guys have faced with technology and banks and getting loans happening through this period of time.
Well, I think some of the biggest thing that we've seen through the COVID crisis was lots of the banks looked to offshore to reduce some of their operating costs. And then what that's done is put a big squeeze on their turnaround times. What we've then seen from that is that the banks have now realized saving some operational costs has cost them in the long term. So now they're bringing teams back onshore. So the great thing about that is some turnaround times really blew out with some of the lenders, and now they're trying to upskill and get more credit assessors ready to go as soon as possible. Something that I was going to say to anybody at the moment, now that you guys were talking about, looking to buy in the market, one thing that I'd be saying to anybody that's looking to buy at the moment, make sure you got your ducks in a row and get your finance ready to rock and roll. Because if you're in a competitive market and you've got multiple buyers at the moment, if you're going to go for an extended finance clause, any vendor would be quite, hesitant to take that. So make sure you're speaking to somebody, hopefully someone at Open Finance, to make sure you've got that ready.
Of course. Yeah, and if people are really hustling, and this is only probably for the select few, I know if you really got your ducks in a row, and you can get a contract signed and do a short settlement, people need to have, and don't quote me for verbatim, but have everything submitted to the bank by the first week of December to have any chance of settling this year. Is that correct?
Yeah, correct.
Yeah.
Correct.
How are the banks tracking with their settlement timeframes and their processing timeframes?
Beg your pardon? Can you repeat that?
How are each of the banks tracking with their assessment timeframes and their?
They've come down a lot. So at one stage, one of the majors was out to 35 days, and they've got it back down to 15 in a matter of 6 weeks, which is pretty crazy to think about it. Something that I was reading earlier about Josh Frydenberg, and he was talking about credit is the livelihood of a healthy economy. So the great thing for us to look forward to is the banks are eager to lend. They just want to make sure we've got the right clients, and they've got all their ducks in a row, and they're ready to purchase.
So do you think there's, that you said they sent it offshore and that slowed down their approval times and their credit checks and all the stuff that goes with it? Was that part of their strategy? We're open for business. We're absolutely open. Long delays though through credit. We want to lend, but big delays because of COVID. Was that part of the ploy?
I think it possibly could work towards, trying to, be in a better position when March comes around and the changing to the lending environment because of the reduced government regulation. So
I've been saying remove shackles, and Cam's asked me to water it down.
I wouldn't. It is removing shackles. It's by all means they're going back to reasonable lending laws come March. And I wouldn't mind you actually talking through the process, because people talk about this March date when the world's going to change. Talk us through what's happened and why this March date, and what the process is that's going to occur.
Well, what the government's trying to do is trying to reduce unnecessary barriers for everyday Australians to get credit, and they're credit worthy Australians. We were putting the National Consumer Credit Protection Act was put in place to stop predatory lending, which really wasn't an issue in Australia in the first instance. It was one of a knee-jerk reaction post-GFC. And we never actually saw the consequences of the GFC or the housing market bubble bursting like it did in America. So it was probably a reaction that was completely unnecessary. And all we will see is probably a more common sense approach to the lending environment, which is what it should have been the whole way through.
Yeah, nice. I've got a couple of questions here, and probably some will definitely relevant to yourself, Christian. Kelvin, thanks for joining us. Paul, Nate, Jess, always good to see you. Matt, Nate, actually I'll roll down while I've got you hot on the trot, Christian. Matt's thrown in there a question. When are lending requirements changing in line with COVID? So it's not really in line with COVID. It's more around that March timeframe. Is that right? That's when we'll see it through April. Yeah.
Yes.
He's heard that they were changing them to make credit more easily available. 100% correct. Scrapping 90-day bank statements, etc. That's not quite right. But talk us through actually what they're reducing as far as the requirements. How is it easier?
Yeah. So where it was more of a lender beware sort of model, where now it's going to come on as a borrower beware model. So the lenders were going through bank accounts to kind of get a realistic diagnosis of what people are spending their money on. The thing that it's really interesting for people to consider is that Australians are some of the best loan repayers in the world. So if we wanted an additional loan with an additional repayment of $500, we'll change our spending habits to accommodate that. So looking at historical expenses is not a real true reflection of somebody's affordability to borrow further funds.
Yeah.
So,
If I can use some numbers and a real example just to illustrate that point. In March of 2019, we had a client who was trying to get finance. The bank assessed them and said, you went to Hawaii in January, so you don't have the disposable income to repay your loan. So we can't approve your loan. What should have happened, what will happen is they'll say, would you not have gone to Hawaii if you had this loan? And everyone would say, I wouldn't have gone to Hawaii, I'd pay my loan repayment. Okay, you're approved. So what they're going back to is a scenario where the borrower says, yep, it's on me. I understand I need to make the right decisions. Not the lender going, based on what you spent last 12 months before you had a loan, you can't afford the loan.
Yeah, and Christian's right. The delinquency rates in Australia were extremely low, even throughout and after the GFC. The real sledgehammer came down from the lenders, obviously, after February 2017. And that's when APRA really put the clamps on and those mortgage calculators tightened up after 60% of the sales in the Sydney market at the back of a hot end of the market were investment loans or interest-only loans. So what they deemed was that 60% of the buyers in Sydney, right at the back end of a market, were speculating, knowing that most of those people would probably cop a little bit of a price correction. So 60% of buyers are going to get a 10, 15% down drop, which is what they got in effect. So that's when the clamps really came down hard, and that needed to happen. And the trouble with that was that markets like Melbourne and Brisbane, which were starting to move, and it were due, especially Brisbane, due for that move. APRA and the banks can't discriminate and go, it's only Sydney buyers that need this clamp put on them. It goes Australia-wide. And that was the trouble with the property market through that period.
But they're also saying things like at that point, there's a lot of offshore buyers buying apartments in Melbourne, and we think there'll be 200,000 delinquencies on settlements coming in the apartment market. Didn't happen. And then, as you said, Sydney market investors are coming in, not offshore investors from Australia, and same concerns didn't happen. So the banks are putting these barriers up that are fixing problems that aren't really there.
Yeah, we've all heard the term nanny state. I don't think you could. Australia's like the ultimate nanny state, aren't we?
And also just what you're saying there, Christian, about they're trying to free up credit to get the economy moving again. We talked about it last month. We've been saying for a long time that our clients or property investors want to be in the market and doing business, but the banks have had the door shut. All of a sudden it suits them. They want the economy to grow, so they're going to put that capital back in the market and make it happen, which is really great.
Yeah. Daniel, thanks for joining us. Glad we answered that question for you. And Matt, hopefully that answers of yourself. Feel free, if we didn't clarify anything perfectly, spit it back through. Nate's got a question. What do you think about renting out a current place of residence as an investment and building new versus staying put and building a dedicated investment property? That might be a good one for you, Matt. So the concept of rent vesting versus staying where you are, buying new or buying new and renting out, or buying new and moving into it. There's a few different scenarios going on there.
Big question.
Yeah.
It's a good question.
I'll just unpack it so I make sure that I'm clear. So they're currently living in a principal place of residence, I assume, from the sounds of it.
Yes.
They're looking to rent that out. So flipping it in basically makes it an investment property.
Potentially.
Building a new principal place of residence and moving into that.
Yes, versus staying put and buying and building a dedicated investment property.
All right. Well, without knowing values and where they are, so I'm talking completely speculative here or hypothetically.
We'll assume for the argument it's like for like-ish.
All right. So if you've been living in a house for a few, let's say 5-10 years perhaps, then you're no longer going to get the depreciation benefits that you'll get for building a brand new investment property. So if you build a brand new investment property to rent that out, you're obviously going to get much better tax benefits than if you just start renting out a house that you've been living in for the last 10 years. So where all that depreciation's kind of gone and waived, you don't get that back to claim again. So I would probably lean towards building the investment property rather than moving out of the house you're in.
But I also think you've got some advantages there. You can sell your principal place with no tax because it's your principal place. But it's probably not the optimum size of quality. So it's a house that's in an area, you've bought on emotion, you haven't bought it based on what the numbers and stats and figures tell you the right reasons to buy it. So I think by taking the option of saying, let's sell it, let's use the money you capitalise out of it to go and buy an investment property. Probably the bit he's missing there maybe, Ken, would be just to draw equity out, stay where you are. If you're going to buy another place anyway, draw equity out and buy an investment property. Use the equity in the current home.
just on that point that you made, Al. So I did almost that thing there where I moved out of a house that we'd owned. In fact, it was a house our kids sort of spent the first few years of their life in, had sentimental attachment to it. We rented it out for 2 years. After 2 years, we asked the tenants to leave and we sold the property because it had gone up in value. It was a great property for capital growth, but it wasn't great from a rental holding perspective. Our cost to hold was too great. So we reallocated our capital and bought a couple of other investment properties elsewhere that were going to get better cost to hold and a similar capital growth in the future.
Did exactly the same actually back in the day. So yeah, it's fun. And rented it out to start with, realised there was no depreciation and there was better options out there. I've got another couple of questions. Nathan, thanks for joining us, mate. I'll just unpack this one. So Nathan said, hey guys, I've just refinanced recently on my investment property and all approvals and subsequent settlement went through very quickly. Awesome. I'm currently duplicating and refinancing my equity loan to free up funds for another deposit plus costs. So this is leaning towards you, Christian. This has dragged out longer than expected. Yep. But are some lenders taking longer than others to approve, even though lending restrictions have relaxed? So it's probably two questions there. Or two.
They haven't come into the full effect of relaxation yet, so we're still a bit of a way away there. And just because it's taken a bit longer, it might not necessarily be any reason for concern. It just, with what's been going on with COVID, banks are just dotting their I's and crossing their T's, especially for people that are located around Melbourne and Sydney. They just want to make sure that people are not too affected from COVID and that moving forward, they're going to have a stable income and have the ability to pay the loan moving forward.
Yeah, and I know loan processing timeframes is probably the last reason you should pick a bank. But how are each of the banks tracking? Are you? I mean, I know your team will be definitely in tune with that. How in tune are you with how long the banks are taking?
Yeah, so the majors are probably sitting anywhere between, from memory, 5 to 10 days, with the exception of one major's taking 15 at the moment. So they're blown out a little bit. If you went back probably 2 years ago, the majors were picking up deals and approving them within 48 hours. So at the moment, it's a little bit slower. The interesting thing will be moving forward. Lots of the lenders are moving into using comprehensive credit reporting, and that's positive credit reporting. Over time, the use of AI, that will turn around, they'll reduce turnaround times for loan approvals moving forward. So the outlook moving forward, I think, for borrowers, good quality borrowers will get approved a lot quicker.
Yep. Go, Louis.
Thanks very much for that, Christian. Probably the other thing in relation to loan processing times or delays, also the valuation process. And I guess one thing I've seen is that valuations or valuers at the moment are very up and down. We're seeing huge variations in valuations, and I think they're just have found it hard for the last 6 months to get a handle on where they think the market is at or what their level of confidence or sentiment is for the market. And I imagine that that's going to improve as Melbourne moves out of lockdown, as we rack up more double donut days. Good. And obviously the talk of the vaccine starts to, I guess, filter through a bit more regularly. Because value is obviously a really important part of that finance process. And when they're ultra conservative and they go through these phases of being ultra conservative, then it can slow down that process as well.
Yeah, and as much as valuers are informed, I mean, obviously a good friend of ours and Jared, who I've built house next door to, so pretty good friends. I built house next door to a guy down in Torquay, so we're reasonably good mates. He runs the valuation for CBRE. But Jared said, as much as they train valuers, they do take in what the newspapers, so there's some sort of consumer sentiment in there in the valuers' decisions until the market data drives through. So they're probably swayed a little bit in different capital cities. So that market data needs to really drop and be sitting there for a period of time. Like buyers, valuers need that market to shift before they change their shift sometimes. So each area and each market, you will get different valuations. You're right.
Yeah. The government's getting some mileage out of that announcement on budget night about the changes to the lending rules, aren't they? So was it Nathan who asked this question, I think?
It was. Yes.
He said he thinks it's happened and lots of people do. And obviously it's happening in March. It's like the old sales trick where you got a sale at the time you made your phone call, you got a sale when they said to go ahead, you got a sale when you pick the contract up, and you're thinking, well, you got 3 sales. It's just the one. They're going to get the same mileage out of this, and come March when it happens, it'll be out in the papers and everyone will be out there on rampage. But
heroes again.
It's certainly been celebrated already.
Yeah, no, I'm looking forward to it. And realistically, while they're saying it's a relaxation of responsible lending laws, it's a recalibration. There was nothing wrong with them previously. There was no, the shackles are off, so it's game on. And that's just one of the major levers that the government's got to put into play. I've got Isaac here. This could be a good question for you, Matt. And Isaac, well, we might not be able to give you specific advice, and you're more than welcome to shoot an email to Cam at Open Corp, and I can put you in touch with one of the investment consultants. I'm not fussed if you use our service or not, but they can probably unpack this a little bit more in more specific detail for you. But this sounds familiar to a position that you were in, Matt, a long time ago, long time ago. Isaac's asked, I'm looking to buy my first investment property. Well done, mate. Small 2-bed unit around 10 k's north of Perth City. Matt knows Perth pretty well. We manage strata, well-managed strata. Currently living in another one in the same complex, but I'm sitting on the fence because I'm planning to study full-time starting 2022, and I don't want to overextend myself financially.
All right. Thanks, Cam. That's a spot on almost. So the first property I bought back in 1998 was a 2-bedroom unit. It was only one of 2. Obviously performed very well, allowed us to leapfrog.
One of 3.
Sorry, what was it?
2 or 3.
Well, you can see how many times I went to visit that one. So Al and I bought that together, and you know who did the leg work on it. So, so I guess I believe that getting into the market, and if a strata unit is the type of property that you can afford and it's an infill, then great. If that's the best property that you can get into at that point in time. I guess one thing I would say is that large complexes, and I don't know how many are in that complex that you're talking about, Isaac, but large complexes can have, I guess, some additional issues that you need to be aware of. So sometimes large complexes of strata units have lower capital growth over time. And that's just because they tend to be traded. There's very little to differentiate between the different units within those developments. But if it's a smaller complex, it's infill, and as I said, it's the first property that you can afford to get into, then it sounds like it could be a winner for you and allow you to get into the market and become a platform that you can then over time grow equity. Now, property was, sorry, go on.
Sorry, I was going to say, we talk a lot about the best time to buy a property is the moment you can buy a property. And there's a couple of reasons for it. One is obviously that the market grows and it makes it harder. Your deposit's got to work harder for you to get into the market. And the second one is shrinkage of deposit. I'll call it the Dave syndrome. A friend of mine who, when he was younger, he got an inheritance, or he had about 100,000, I think, and he considered buying 2 properties.
I think he shrunk it by a bit of this.
Cheaper. But then a bit of time went by and his deposit was 80, and then a bit of time went by and it was 60, and then a bit of time went by and it was 30. A bit of time went by and he had a holiday and said, I'll just spend the rest of it now. No deposit for a house anymore. So if you don't put it somewhere and make it work for you, you've got access to it, and there is a tendency to chip away for different reasons. So there's a couple of reasons to buy as soon as you can. One is growth of the market. The other is just getting your deposit out of your hands so you can't tap into it.
And Matt, I just want to couple off the back of that, because how did you go? And with you were studying through that period of time, so that's what Isaac's planning to do. Get something before he goes back to study. Financially, how did you battle through that, mate?
Yeah, I mean, I first of all, was obviously a uni student when I was servicing the loan to start with, and wasn't earning a lot of money, so it was a bit of a trade-off. I still got to go out and have a good time with my mates, but I was drinking beer, not cocktails. And you just make smart decisions about those sorts of things. But I guess one thing I was going to say as
through a beer bong.
You just get the key and smash it into the side of the can.
Old school.
Okay.
No, the other thing I was going to say was that I guess also coming into a strata complex, and again, if you're a student, maybe tax benefits will be different, but there is obviously depreciation that you may not get if it's in an older complex, as well as having to think about some of the strata fees that you would pay as an owner. If you're renting in the complex yourself, you may not see those strata fees, but that's something to be mindful of. And there's also a government grant at the moment, or multiple government grants in WA to build new. And now I don't know any of the circumstance you've got. And as Cam said, if you wanted to talk to one of our consultants and at least work through that to see whether there's alternatives that may be better, obviously we can help. But in any event, I think that the path you're heading down sounds like a reasonable path to go down.
The easiest way to work it out, Isaac, if you are satisfied with the property itself. So you got two components here. Are you satisfied buying the property yourself? And I think the large majority would say if you can get into the market and that's the lowest you could afford, quality property and price point, then thumbs up, get into the market as soon as you can. But the other side of things is a really basic calculation. While I'm at uni, how much money do I earn? How much disposable income do I have to put towards the property? And if for some reason you had to study like Christian is and do 3 MBA subjects in one term for some reason, and you can't earn money, how much buffer do you have to sit in the bank to make the difference up if you've got a tenant that leaves or if there's a difference between the rental yield and the repayments?
And you might talk to Christian and say, what are my repayments? Because across the country right now, many properties aren't costing anything out of your pocket. So
yeah, that's a good point.
Christian would be the one to talk to and say, what are my repayments likely to be? You know what the rents will be, and there's some equations in the middle.
So at christian@openfinance.com.au, is that right, Christian?
Yeah, or just help at Open Finance.
Help at Open Finance, easy. Isaac, flick through your details to Christian, at least you can do a borrowing capacity for you. Nick, thanks for joining us. Mark, thanks for joining us, mate. Nick, I'll just, any tips on helping with finding the right type of property and where to look? I'm not sure if I should be looking locally in Melbourne or interstate at the moment. Ripper question, Nick. We do have a property advisory division. Matt, it's an individual circumstance. Matt works with our investment consultants who bring him an individual situation and then work through that with his acquisition team to go and find the right property for each individual. So it's a very individual question, mate.
I think you've covered it pretty well in the map section in your 4-year-old book though, Cam. That'd be a pretty good leg up for him to go and have a look at and get started. Yeah,
true. There are areas, just I like both Melbourne, but I also like some capital cities interstate. Shoot us an email if you want, Cam at Open Corp, and I'll point you in the right direction, have a chat to you and point you in the right direction. More than happy to go into detail, find out a bit more about your situation. Anthony, hey guys. Tips on how to negotiate a better interest rate on investment loans. There you go, Christian. Spike that one up.
The best way to do it is actually speak to a mortgage broker just to get an idea of what's in the market. The benefit of doing that is you can play the banks off each other. Banks are being really aggressive at the moment to try and get clients on their books. So most lenders are trying to do whatever they can to keep existing clients because it's less heavy lifting for them. And if they can keep one client on their books, it's less expense that they're going to incur to bring another client on the books. So speak to a broker and get an idea of what's in the market. And we always think it's a really important time for everybody to be revisiting their loans at a maximum every 3 to 3.5 years.
Yep.
Because loans become redundant. And the reason why banks make money is by people being complacent and not coming back to them and asking for a better rate or looking for a more innovative product out in the market.
There's some ripping rates out at the moment, especially if people need to be careful if they're thinking of investing and building their portfolio. I was talking to someone during the week. Banks are offering fixed loans at 4 years at 1.89, 1.91, 1.99. I heard Westpac had today. So some absolutely ripping rates for locking in for 4 years. The only thing you need to be concerned about is if you do lock in, trying to access equity growth to duplicate your portfolio. So that's the only trade-off if you're an investor and that's what you want to do. Go, Louis.
Yep. You can lock down interest rates on part of your portfolio and leave some of it variable as well. And I guess just thinking about the interest rate cycle, I mean, now's an incredible time to be locking in interest rates. I know people often try to lock in interest rates when interest rates are on their way up. They say, I better lock in now before it gets too high. Yeah. Actually, the best time to lock in interest rates is when they're at their cyclical bottom. And right now, obviously, vaccine was announced during the week, likely to start rolling out next March. There's another 3 hot on its heels. don't be surprised if over the next 12 months interest rates do start to, at least long-term interest rates, start to creep up, because banks will start repricing. So great time to be talking to people who can create that competitive tension with the lenders, so the brokers, who obviously can play them all off against each other on your benefit to try and get you the best deal.
I've got my own opinion on it, but Christian, do you think interest rates are the best measure of the lender you should choose?
I think it's going to be dependent on your scenario. Some lenders will have a better interest rate for a particular purpose, but then some lenders will allow you to have an increased borrowing capacity, so you might pay a little bit extra. So you're just going to have to consider your circumstance, so that if you want to duplicate and get into a second property and you've got to pay 0.2 or 0.3 above what the best rate in the market, then it's an easy decision. I'd pay the extra 0.2 to 0.3 to get another investment where the money's working for me.
Yep.
Yeah.
I think
Paul,
when the three of us, the three of us were building our portfolios, that was absolutely the mantra. Interest rate was important, but not the most important. It was about what will give me access to capital to go and buy the next property, to get the growth to buy the property after that. So I wasn't focused on screwing down the bank as much as I could.
Yeah, and Al did us a favour. Was it about a month ago? Probably needs to do it again. Where so everyone needs to be across it. Al just emailed me and said, "You owe me a beer. I've just saved you X 100,000 on the interest because I spoke to the bank for you." So we've got a few bits and pieces together. So appreciate that. Paul, thanks for joining us. Procrastinated for 10 years looking for the right property, the right place, then found OpenCorp. Awesome. The name rings a bell, Paul, and then do all the hard work for you. 2 properties now, very happy. Just wish I'd started earlier, missed out on a lot of capital growth over that time. Awesome, mate. Glad you've been satisfied with the service. Look forward to catching up at a client night very shortly. I hope you enjoyed the online one recently, but it'd be good to see some client. That is one of the things I've missed most this year, is actually having a client nights or family fun days. So it's, getting to rub shoulders and talk to people who love property all day long. Well, you guys are good to talk to. Gets a bit boring sometimes. No, I'm joking. Louis, we've talked about, and there's been a couple of comments about what markets, where we should buy and those sort of things. Your acquisition team have pieced together with obviously a lot of different data and a lot of different research, the quarterly market report. Run us through some of what's going on.
Look, probably the big things, and it's a trend we've been talking about for the last few months, obviously tightening vacancy rates around the country. While the newspapers were all focused on the, ballooning vacancies around the CBDs, people didn't realise that was literally concentrated around CBDs. You got Sydney CBD or the high density areas, we've seen higher vacancies because obviously a lot of the non-permanent residents who were here temporarily have vacated, gone back overseas, and they were living in apartments. They tend to, focus on apartments, but the housing markets, like southeastern suburbs of Melbourne, 1.1% vacancy rate versus Melbourne CBD at 8%.
It's crazy.
You've got the northern suburbs of Brisbane at 1%. You've got the eastern suburbs of Brisbane at 1%. Perth, you've got vacancy rates of 1% pretty much every market around there. And we've gone through this period over the last 7 months of massive underbuilding. So while home builder obviously has been great to spark up first of all, the land market is probably the leading indicator. There's developers are selling land hand over fist at the moment. If it can be titled and construction start before Christmas to qualify for home builder, that's just
snapped up and gone.
The hottest thing in their country at the moment. But that's obviously going to catch up a little bit on some of the underbuilding that's happened this year. But we're really still seeing tightening markets in a lot of those key metropolitan markets, and that's obviously a precursor to increasing rents, and then increasing rents are another precursor to inflating prices again. So it's really seems to me to be the start of that next cycle of house price growth. And I guess you're coupling all those things with obviously borrowing capacity that's gone up substantially as a result of interest rates coming down. Obviously, interest rates are the biggest single expense of holding an investment property. So when they drop from 3 to 2%, your cost of finance has dropped by 33%, which means theoretically you can pay 33% more for the property without spending any more on your interest payments. So that's obviously going to drive house price growth over the next couple of years as confidence also continues to come in. And this, I'm almost out of breath, but
Right.
this year we have seen over the last few months, obviously first home buyers have been really driving the sales volume, and investors were, I think we've had a lot of investors who have really seen that it was a great time to buy. They spotted that it was a lull, not a structural change in the market, and that was great. But I guess around the country, investors have been fairly absent for the last few months, and they're starting to come in higher and higher numbers. And that's going to drive into the next cycle as well, over or beyond Christmas and into next year, bringing more and more people into that buying market. So, interesting times.
Have investors been absent though, largely for the last few years due to the banks? Like, the banks have made it increasingly difficult for investors to be in the market. So, are we going to see a return of investors pushing that market come March and April, do you think?
Well, you needed about 40% more income for the same borrowing as you did, from January to March in 17. So 100%, it's been tougher. And
it's like you were saying, they made that decision in Sydney. We've got lots of investors, let's make it hard for them so they can leave the market. And they have made it very hard. But all of a sudden, as I said, these changes are coming March and April. So do you think, Matt, we'll start to see? And I know lots of people you talk to are saying, I've got a property or two, I'm ready to buy another one, but the bank is just holding me back. But under normal lending criteria, they should be right. So will we see that push driving the market as well?
Yeah, there's some consumer data that comes out every few months about essentially gauging the market's propensity to buy. And the time to buy, or now is the best time to buy, is scoring off the charts at the moment relative to the last 4 or 5 years. But we did see, even just before COVID, we were seeing that resurgence early 2020. January through to March was just absolutely off the charts in terms of buyer activity from owner-occupiers and investors. Obviously, COVID brought that down to zero temporarily. Within a couple of months, that had started building back up again. It just keeps creeping up month after month. It's building momentum.
Yeah. Nathan's got a question. Al, you obviously run our property management division. Nathan's got a question. What's your strategy for tenants who've been perfect up until COVID period, have not declared hardship, but have fallen into arrears and maintenance costs due to damage, and damage has increased? The concern that the rental increase may reduce if lease is broken given the current circumstance. So, yeah, right. So if he boots him out, is he going to get less rent? I think is the question there.
Okay. So there's a couple of things. One, it's still really hard to get rid of a tenant around the country till the back end of March due to COVID rules, and they've brought some legislation in that prevented people being kicked out. There's been some shifty tenants who have taken that and said, well, I don't need to pay rent now. The vast majority of people, if they needed to get a payment plan, provided the detailed documentation and got an approved payment plan. But there are some shifty ones who have just, and I had a conversation yesterday about it, who have just blatantly said, well, you can't throw me out, so good luck. But I guess what I'd be saying to Nathan is, rental market, like a buyer's market, is supply and demand driven. When we're sitting at vacancy rates of sort of 1%, there's lots of tenants looking to move in. We're starting to see increases in what people are paying for rents. Some circumstances of tenants coming in early saying, I'll pay above the asking price, which I wouldn't get excited about. Normally they're shitty tenants, but what it does demonstrate is there's a shortage of houses out there. But I wouldn't be worried if someone leaves a vacancy. So it concerns me they're damaging your property, concerns me they're not paying rent. I'll be taking the steps you need to throw them out. And I think you'd be pretty right to get a tenant quick. Definitely the same rent if you just aim at that, but there might be a chance for more.
Yeah, sometimes even the lodgement of a QCAT, VCAT appeal, and they've got a big backlog. So if you're thinking about it, then put it in to start with. You get your case in the queue. Sometimes just that being in the queue can smarten someone up if they're not under hardship and they're just taking the piss out of you.
Is it Vic, or because if it's outside of Victoria, I think it's December 31st, isn't it? The moratorium on evictions lifts.
Yeah.
Victoria's
we extended it. Yeah.
Daniel, nice one. You stuck due to lending rules. Looking forward to March. We've got a lot of clients who are looking forward to post March. So Christian, get your loan writing boots on with you and the team nationwide, because there's going to be a lot of people ready to buy property come March. Now, Matt, you mentioned precursors before to increase in established home values. and some of the things that people can look for. I know land price going up is obviously a precursor to established prices going up, because once the land price goes up, you add your building costs on, that total package price is then higher. So once those sales come through, then obviously established market moves to rise with it. Talk us through a bit about how that happens, if if you've seen that on the ground at all. But also, I'd be expecting, and hopefully my builders aren't listening to me, but you get the old, steel price has gone up, time to put the building costs up as well. So it wouldn't surprise me. That hasn't happened for a number of years. So costs have remained pretty stagnant with building costs as well.
It's the concrete prices of 2018 in Melbourne when the tunnel was taking all the concrete.
Oh yeah, that was a good one.
Well, we can laugh about it, but it's already happening.
I know.
So Perth civil contractors have been putting their prices up. Builders have been putting their price up. In fact, builders stopped taking orders at the end of this week, I understand, because they don't think that they can lock in prices for next year, knowing that they can't start construction until June. And they just said, all right, well, even though technically if we keep signing contracts till Christmas, they'll qualify for the Perth home boost. The builders are worried about their trade prices. So there's just such a backlog of work. There's also infrastructure jobs that all the state governments are investing in, that's taking trades, creating jobs. So as you said, Cam, like the replacement cost of a house, if that goes up, and that's the land price, that's the construction cost, then it obviously brings up the established house prices as well, because people start to go to trade off and say, all right, well, convenience, I can walk straight into a house today or sign a contract, move in next month, have it furnished quickly and be living there, or I can go through the process of signing a contract, waiting 6 months for the land to be ready, building the house. That might take another 9 months, and I'm renting this whole time. Gee, it's going to be a lot easier to buy a house that's already built. So obviously we've seen land prices escalating probably about 10% in the last 3 or 4 months, just because of all the activity that's happening. And we're starting to see the builders sort of show signs of stress in terms of being able to get onto site and build. That's not so much the case in Melbourne, because builders have been held back as well. But talking to trades directly, they're now saying they've got a big workbook of renovation work as well as new homes coming through. So I absolutely think early next year, people are going to be riding this jobs wave, just going, oh, how good's life? I'm just booked out for the next year. Yeah. And if I've got people who want me to work for them, it's going to put my price up a little bit if they pay it.
Yeah.
Great.
The question, what are some good metrics to judge the established housing market?
Mm-hmm.
Was that the question?
No, I was just freestyling myself.
One of the key ones, I mean, as everyone knows, and we talk about it every time we get on here, is supply and demand drives the market. And we talk rental vacancy rates every single time. But a metric I look at so regularly is days on market. If it's drifting out, then the market's not strong. If it's coming in, the number of days that a property is sitting there and on the market as an average, the market's improving. And both those things just tell me really what's happening with supply and demand. There's just some numbers out there to tell you those things.
Yeah, it's a really good point, Al, because obviously in the new build space, the amount of titled stock on market is a really good indicator as well. There's no titled stock on market at all at the moment. It's pushed out. And people need, this coincides with a point that Matt made before about builders not taking on any more contracts in Perth, because I've seen this in both Melbourne and Brisbane in previous cycles when the titles dates had pushed out that far that it went over the time frame which is in the build contract, and the builder said, I'm not honouring the build price, and the build price had gone up $30,000 thereabout. And it was only because we had power with those builders to hold them accountable to build at the original client price, because we said, well, we're going to give you additional builds from other clients. You need to hold the price for those clients at the original contracted price. But if they were just an individual person, the contract would have got wiped and the builder would have walked away from it. So check your building contracts. Just make sure those end dates, or there's after a certain date in time, the builder has got the option for an escalation, but they can't just wipe your contract.
Those are the days that Uber drivers were bird dogging blocks, wasn't it?
Yeah, that's right. The old bird dogging.
Three people that bought and sold it before it got to title after the developer released it.
Yeah, the old bird doggers tend to be the last ones that holding the can too. I've seen a lot of people holding overpriced blocks of land, wondering how they're going to settle on these things when no one wants to buy them.
It's musical chairs, isn't it? You
Yeah.
just the music's going to stop eventually, and if you're not planning on getting this, like on sitting down yourself, you go, oh damn, the music stopped, and I stuck with it.
Yeah,
It did not make sense, but I'm sure you guys get what I'm talking about.
Or bird dogging. Is that what
Yeah. Carrying the can, is that the term? All right, so talk us through the structure of your team, Christian. You've got a lot of loan writers, you've got a lot of admin staff for processing paperwork and those sort of things. Probably one thing I'd like to know and ask you, and I'd probably piece it together if I think about doctors, and this comes down to the difference between a loan writer or a broker who understands investment finance versus 99% of brokers who understand how to write a home loan. It's similar to a doctor. If I was going to the doctor and I had a bad eye and I said to a foot doctor, can you operate on my eye? The difference between that is very similar to someone going to the wrong type of broker. Talk us through the structure of your team and also what the difference is and what an investment finance broker would look for as opposed to someone who's just smacking out home loans.
Yeah, so probably just a normal mortgage broker. So if you go to the bank direct, that's just getting a diagnosis from Google.
Right.
If you go to a mortgage broker, then you're probably going to the local GP. If you go into an investment mortgage broker, you're probably going to a neurosurgeon. So they'll understand the complexities of.
Off the cuff, that's good.
Yeah, I like that. That's not bad. I remember that one. I'm going to use that and pretend it's my own.
They'll understand the complexities and the strategies and always looking for duplication and always having the flexibility to move the portfolio as you need. How a really effective mortgage broker, they'll have a team around them so that the mortgage broker is just continually diagnosing and re-engineering somebody's portfolio to help continuous growth. Our team at Open Finance, we're always looking for opportunities for our clients to continually duplicate and save money at the same time. We're not a set and forget sort of operation. There's been, a lot of instances where a broker, whenever we see a broker that's been on the same home loan for 5 years, it's like blasphemy. We're looking at the interest rate and they're like, hey, no one's touched my loan for a period of time. And we're just like, what is going on? So if anything, that's a great opportunity. And that's the reason we've got such a big team. Our team, we've got some front office support team. So what they'll be doing is getting you primed so that when you actually sit down with a mortgage broker, they can make an effective diagnosis really, really quickly so that you're ready. They can pull the trigger and you're ready to go.
Yeah.
Some of these one-man bands, they're dragging the process, and an application could drag into, instead of weeks from submission or initial appointment to approval, it could be taking months, some instances even 6 months. We want to get our clients ready to go, and get them into the bank as quickly as possible.
Yeah.
These numbers right, Cam. Sorry, Matt. These numbers right. That one client we saved 19,000 per year by refinancing.
Yeah, that was.
And another client that's on one property. Another client we saved 60,000 across 5. I think Amanda talked about the client.
That was Amanda's client. Yeah.
64 or 68,000 per year. Yeah.
So you're just saying about the set and forget. So I had an Uber driver in Perth, must have been last year because I haven't been there this year due to COVID. And I said, how often do you drive? And he said, well, I used to I'm a mortgage broker as well, but I stopped sort of seeking out new business about 6 years ago. Now I just sit, like my phone rings every now and then. It's just a client telling me to refinance them, and it's great. I just service those clients. I was like, so like, what do you do in between? How are you helping them? He said, look, they're happy. I don't need to call them or anything. They just call me when they want me to refinance. So that's just the worst.
I think that's good for us. That's good for other mortgage brokers.
Yeah, I think and just to explain to people, probably the easy way to do things is not often the right way. So if we're looking at trying to ensure that our portfolio is not cross-secured, I think is probably one of the biggest mistakes made in the mortgage broking industry for investors. So if I've got a loan with ABC Bank and I go to a mortgage broker and say I want an investment property, the easiest way for them to get me a loan is to refinance my current home, cross-collateralized with the same bank, jam the investment property in together, and they're cross-secured together. It's just easy. Get paid similar because the loan amounts are large. What they need to be doing is going to my existing loan, creating an equity loan or a line of credit, taking that money and going to another bank, so it's double the work. They don't get paid any more for it, or it's very minimal difference. So it's double the work, but that's going to allow me to duplicate. So ensuring you've got those types of structures set up, especially if you're investing in interstate. Brendan, how are you, mate? Yes, 100%. You're right. Sunset clauses have been removed from Vic now. So that was. Yeah.
And Christian touched on it before about interest rates. A good mortgage broker is going to say to you, what are you trying to achieve? And talk to you about the best structure for you. Not saying, I'll get you 1.89%, but it'll hurt like hell when you're trying to get out of it in 4 years' time because you can't try to duplicate in 3.
Yeah.
So a good mortgage broker is going to sit down and understand what you want and structure it, as Cam said. Not doing it the easy way, doing it the way that's right for you, and putting in place things that are going to make your journey easier along the way.
Yeah, I think if people are interested in really understanding that structure, Michael Bozza-Beresford on the Open Corp website, I think if you type in Finance 101, it might be the video, or if in YouTube, Finance 101, Michael Beresford's video, which he whiteboards out the right structure and the way you can duplicate your portfolio.
It's a really cryptic name.
What, Finance 101?
Yeah.
Yeah, pretty straightforward, isn't it? Markets that are hot at this point in time, Louis. Where are you seeing pressure on supply?
It's definitely like where I was on the phone to people. Pretty much, I was on the phone to agents in southeast Melbourne this afternoon and Brisbane, and pretty much most of the markets. I'm talking to the agents in Brisbane. It's really tough, like getting allocations, and they're just saying they're pretty much out of stock in a lot of cases. So they're having to pull really big favours to get allocations for our clients at the moment. But just a sign of, like, I haven't seen the market this tight before, and
it's good.
It's hard work, but it just goes to show, obviously, that the demand's pretty broad across Australia at the moment.
Actually, I want to go through a couple of figures. You might remember these. This is from, just to plug our book, Matt, Investing in the New Normal. I want to go through.
It wouldn't be an online show without a plug for that book, would it?
I don't do anything else. I'll go for a run. I take it with me, and when I run past people.
Or you drop something. You drop something.
Drop something. Oh, it's Investing in the New Normal.
Oh, is that yours? Oh.
Yeah. There you go. I wanted to look at, keep spitballing while I find this graph in here, because it's a really poignant one about looking at when we're looking through this data, is the share markets.
So Open Corp, or you're looking for that, Cam, Open Corp have just opened their 6th office and their 1st office in Thailand in the last 3 weeks, which is really exciting for us.
There you go. It's amazing how you can work remotely.
And I guess we're really big on trying to make sure that we provide the best service we can, find the right people, the best people. And we now have an office in Thailand doing some work for us, which is really exciting.
Yeah, it's good. Rob relocated over there, so living the dream. We've got team members living in Sunshine Coast now, Byron Bay, all over the place. So, yeah, living the dream.
And I guess probably the other thing to say about that, one of the great things, and obviously even having Christian in the Sunshine Coast, having people in a market, like, you do get to draw on more experience as well. And obviously Christian's role is not to go out and find us land in the Sunshine Coast, but it's one of the things that I've always found and I've talked to our research team, you have to have your ear to the ground everywhere. Like, when you talk to people, ask them what's happening in the market, like, find out what they know about the market. And obviously everybody has I guess they have a bit of bias when they're telling you something. So you have to be able to filter things, but it's really important. If you want to know the market, you have to talk to as many people and have a broader view as possible.
Yeah. Leonie, awesome. You got your book. No worries for the extra copy. Glad you're halfway through it. One thing which is just on the back end, and this probably was really interesting, that the facts that we went into, which is actually looking at the share market and what occurs after downturns. And what Matt and I discovered through some reports, it was the JP Morgan report, actually, and looked at 20 years worth of the share market. And if you held shares for 20 years, got your dividends and reinvested them, the compounding return would have been, was it 8.2%? Now, this what was interesting about that is if you missed the top 10 trading days, your returns went to 4.5%. If you missed the top 20, it was 2.1%. And if you missed the top 30 trading days in 20 years, you're at 0%. So there's really small bits of time and only very small amount of days where you get growth in the share market. What I think was most interesting, and this correlates to the property markets, is that in the 20 years, 6 of the market's best days occurred within 2 weeks of the 10 worst days. So 60% of the really ripping days happen within a fortnight of a crash. So it's just, so most people, the second the share market tanks, they rip their money out and stick their head in the sand. Those that ride it out are obviously get the upside. So while the share market obviously is a lot more liquid than the property market, you know what I mean? If the world sneezes, then immediately the share market drops. Property market doesn't have that sort of, we haven't got that sort of immediate liquidity in property. So people want to make sure they don't lose money, so they don't sell out that fast, 60 days marketing campaign. But what we saw at the back end of each of these economic downturns is that while the share market responds fairly well at the back end of a crash, the property market within 18 to 24 months has cranked after nearly every downturn we've had.
And there's a few different reasons for that, isn't there? Because there's the sense of relief I've seen through COVID, for instance, and now we're coming out the other side. Geez, it's going to be another great 10 years for us. There's also the stimulus that gets pumped into the economy. There's the reduction in interest rates that obviously makes people's borrowing capacity more. So there's a lot of really logical reasons why that's going to happen. And also in terms of that, like the fact that property markets don't drop 30% overnight like the share market did. There's nobody living in the companies. When you're selling shares, it's just a bit of paper or a digital transaction. If you want to sell a house, you got someone living in it. You got a whole process to go through, and often cooler heads prevail. You get through the panic, and you start to realize actually the sky's not falling, and things are going to be okay. I can hold on, and that's why the property markets are less volatile, but they certainly get the uptick normally starting within 9 to 12 months of the initial correction.
Yeah. Do you think, so obviously with the stock market, you can get emotional, make a decision immediately, sell your shares in 3 minutes if you wanted to, and rip yourself out of the market because you're worried. Property obviously doesn't enable that, but if the same emotion could be put into the market, do you think we'd see that? Do you think that's the nature of property, that you can't get emotional about it like that because it takes 60, 90 days to do a transaction? So you've breathed, you've calmed down, you've thought it through, you've gone, okay, the sky's not really falling, I'll move on. Just literally the nature of the market. And if property could transact that quickly,
you do
things, people panicking.
You do see that to a degree in the apartment market when you've got whole buildings that are under contract and people pull out of the contracts when the world sneezes.
No one's living in it yet. Yeah.
Yeah, correct. So you do get that sudden drops in apartment prices. Sorry, Louis, you were going to say something?
No, I was just going to say the emotion's normally on the buy side. And as you know, if somebody wants something more than the other person, they tend to get the worst deal. And normally people are more emotional about buying than they are about selling. You're logical about selling, but you turned up, you saw something nice, you go, oh, no, I'm going to miss out if I don't get it. And you'll pay whatever you need to get it, or try and get it off the market before somebody else. So that obviously also has an inflating effect on the market. Whereas you're selling, you're going to be a bit more cautious, you take a bit longer. You don't want to take a deal too early often. In fact, people more often than not get a worse deal when they're selling because they hold on for too long, as opposed to panic and sell too quickly.
Yeah. Craig's asked, when you're opening an office in Sydney, we do have team members in Sydney, especially in the finance space. How many team members you got in Sydney, Christian?
We've got just 2 in Sydney at the moment.
Two in Sydney, yeah. Investment consulting team. We do love traveling to Sydney, and we've got a huge client base in Sydney. There's no immediate plans to open up in Sydney. Although, we love getting up there a couple of times a year for client nights and those sort of things. So I don't want to lead you down a garden path and say we'll be opening up something early next year. But it is on constant discussion though.
I think if anything, COVID's probably proven the world's quite small. Like Christian could be in Chicago and having the same meeting with us right now. What we've learned is technology can really enable people to come together pretty quickly. Yeah.
One thing just on Sydney as well, because we do look at the market, we're always talking about it, but we tend to find Sydney is a great lead indicator for the rest of the economy in the market. It's the price setter. We know generally that Melbourne's prices are never going to go above Sydney's, and similarly with Brisbane. So Sydney gives us a chance to see, I guess, where price levels can get to in the other markets. So that's obviously one of the advantages we have of not being active in Sydney, but using Sydney as a good barometer. The other thing with Sydney is, and Melbourne, I guess to a lesser extent, they make up over 50% of the Australian market. So when those markets are hot or cold, it's driving interest rates. So if Melbourne's market is cool and Sydney's market is cool, generally interest rates will be coming down because they want to promote more construction. But yeah, that obviously helps the other markets and us to know sort of with plenty of advance warning when markets are going to go up or to stagnate.
But I think it's important, Matt. So we're not deliberately sitting out of Sydney. We just, the numbers don't make sense. Like is it weekly or fortnightly or monthly basis that you're running these reports that say to us, here's the metrics through Sydney, here's where it works, here's where it doesn't work. We're not sitting there saying we just won't do it because it's an indicator that leads the market. We're actually looking at the numbers to say, when can we get in? But it's not right.
If Sydney's vacancy rate drops below 2%, absolutely, we'll be keen as mustard to get in there. It's been years since it was below 2%. It's been sort of the most oversupplied market for quite some time. Obviously, there's been some capital growth at the same time still, but you look at the rental yields of Sydney, the cost of holding a property in Sydney right now is completely different to Brisbane, for instance, where you're getting about almost a 5% yield. And even just looking, and that's probably one of the reasons why when you look across the Australian property market, the average rental yield over the last 10 years has been 3.2%. The average rental yield across OpenCorp's portfolio of over 1,000 properties is 4.6%. And that means that there's a very low cost to hold. In fact, a lot of our properties now are cash flow positive, but it's very hard to do the same in Sydney. And we know that it's not just about getting capital growth on one property, it's about being able to hold multiple properties. So the cost to hold is really, really important. If you can hold multiple properties with a low cost to hold, then they're all going up in value, and then you're going to end up much better off than just only one property that's burning.
If you've got a team to show us how much more it costs to hold a property, percentage-wise, in, say, Sydney versus Melbourne or Brisbane, be great to see.
Kelvin's asked, are you more Queensland-based? Team-wise, our head office is in Melbourne. The three of us live in Melbourne. Christian's in Sunny Coast, runs a team nationally for the finance. But as far as investment goes, I've actually got a slightly more swayed portfolio personally in Brisbane currently than I do Melbourne. But I still like the Melbourne market at this point in time. Michael said, huge fan of OpenCorp, mate. Very, very much appreciated. Question for my wife, also a fan. It's a very strange word, mate, but we'll take it. Al will probably take it. Al will be telling his wife that he's got fans later on. So, could your wives be included in some of these live chats? That's actually a River question. As I'd love to hear.
They love it. They absolutely love it.
Yeah, I was just thinking, trying to get Felicity on. Geez, that'd be a tough gig. And it's actually a really good question. Could your wives be included in some of these live chats? She would love to hear their thoughts through the decision making and also their worries. Thanks, guys. I reckon just trying to work a way that I could pose it to Felicity that'd be any way that she'd say yes. Just because she's a pretty private person. I reckon Claire would probably be the best chance of having a chat. Louis, you reckon there's a chance?
Maybe. She'll just hang it on us, though. Do we really want that?
I think if I could get Beth to drink 2 bottles of champagne, not tell her the show was on, and then drag her in front of the computer, she may talk to everyone.
The 2 bottles of champagne wouldn't be hard, but it's I think it's a pretty relevant question because man, I hate sitting around as the guys club when I know Felicity and I talk very evenly and openly about what our investment decisions are and always have. Early days, and I don't want to talk for her, but she was 19 when she bought our first property. I was the older guy, 23, I think I was. 36. And, 36 also, 23. And I remember I talked Felicity. I'd had a few properties at that stage and talked Felicity at the tender age of 19 while she's still living at home to buy a property. probably did it the wrong way because she didn't tell her dad until after she'd signed a contract. So we went home and told Pete, look, Felicity's bought a property, was seriously not happy. And I can understand that now, obviously being a dad myself, why this young guy's talked his daughter into buying a house. Then we said to her, Dad, it's not actually just investment property. We're putting 4 units on the back of it. So that was her first purchase. So Pete likes me now, actually works for me, but it took him about a year to speak to me. But Felicity was very, very nervous early days. She was going, why are we doing this? We had no money coming in because I was working a couple of jobs. She was working really shit money back then. And she would definitely have the middle of the nights. What have we done? Why are you making us buy houses? Nowadays, you know, we get all the holidays we want with the kids, and you know, she's definitely come around to that. But early days, 100% big fears.
Speaking of fans, I've forgotten this story. So my wife was saying it recently. We're in a restaurant, we're eating, and a person called me over and said, "Oh, are you Al? I've seen you on the internet, seen your videos, your WODs, or whatever it was."
You'd love that.
Talked for 5 or 10 minutes, went back to the table.
So vain.
I said, "Oh, just one of my fans." They said, "That's great. You've got half a letter stuck to the side of your face."
Actually, I think one of the most humbling moments. That's outstanding because it makes me feel better. Yeah, we were at High Point Shoppo, Gus and I, and we just gone and see the new Star Wars, and we're coming down an escalator, and a guy was coming out the other way with his family. He goes, like, just as you're sort of passing, goes, "Cam." I had no idea. Gus has actually got a Kylo Ren mask on. And his wife goes, "Oh, we watch your videos. We love you." And then the guy goes, "Zach, you see that guy there? He's the reason we can afford your school fees." Oh, that's fantastic. That was that was a good feeling, no doubt. And Gus is going, "Why are random people yelling at you on escalators?"
Yeah. His mask was twisted on his face.
Yeah, that's right. That's a ripper question, Michael. And I'm trying to think of a way how I could get Felicity on here. I truly am.
But maybe because I can't imagine either or any of the wives will jump on. What are the questions? Email cam@opencorp.com.au and we'll get them to respond.
Actually,
we could get them to do a video. I think they'd feel
what I was
uncomfortable
thinking.
doing live, but you could get them to do a video and answer some of the questions.
Yeah, actually, that's a really good question, even just in front of video, because then it doesn't matter if she feels like she's going to stuff up, even though she wouldn't. That's all right. We'll see if we can piece that together. Michael,
No, we're not promising. Please don't put your hopes up.
Yeah, I reckon there's a chance. There's a near chance, especially if it's just asking about early days. If you're not getting into property strategy and those sort of things, because she blanks out. She hasn't even read My 4-Year-Old Property Investor, Felicity. That's horrendous.
I could put a wig on, pretend that I'm her, and I could just answer.
I'll tell you what, she's way better looking than you. Michael, if you feel like it, shoot us through any questions, cam@opencorp.com.au for Felicity, and I reckon there could be a chance. I'm not promising anything, but yeah.
You should set up should set up over the next week just an ask the wife thing. We'll get the top 10 questions. See if we can get the girls to.
It's funny, isn't it? Because we've got a huge number of our clients, and we obviously do, Ladies' Day for our clients, because you get the driver and passenger in each relationship, and we've got a huge number of our clients who, the wife or the female partner is the driver of the couple. And I tell you what, decision-making process with females is so much easier. Once they understand it, they're going ahead with things. They're just much more analytical. I actually did a WOD, a video, workout of the day, we call them, Invest Like a Girl. So I saw this awesome video, and this was one of those ones that was nearly a tearjerker. I've got 3 daughters, so it hit home for me. And it was Google it, Like a Girl. It's a video. It's fantastic. I can't remember the company that did it, but what they did is they got a heap of young girls, and they said, all right, I want you to throw like a girl or run like a girl. Sorry, at first they got the older, so 16, 17-year-olds. They said, run like a girl. And the girls are running, throwing their hands up in the air, and they're saying, throw like a girl, and they're throwing like really limp-wristed. Then they said to 8-year-old girls, run like a girl, and the determination was unbelievable. So what the point of the video was that there was some point during, those years where girls doubt the power that they've got. So I was showing my girls that, and so I started unhinging all of the different things about what investing, the difference between the decision-making process of, girls and guys when it comes to investing. And I tell you what, as an investor, the girls have got so much more strength. They can think of multiple things. They're not, blasé about their decisions. It's so I actually did a WOD video off the back of that one and went through all the different traits of, and probably just to give my strength to my own girls. So, but better fans than haters. Exactly right, Kelvin. Yeah, that's right. Don't know if we had trolls. We had trolls. I think I had one guy say, "You look drunk, Cam," because I laughed really hard on one of these.
Shouldn't laugh. Should not laugh.
Should not laugh. Don't have any fun.
Yeah, Christian's crossfitting 25 days a month.
Crazy.
Rip the shirt off, Christian.
It's no, you guys haven't got your sunglasses on, so you might go blind.
Indoors too much.
Yeah. The Irish heritage.
Yeah. I think we've got to the point of rabbiting on about girls and guys and dribble, and we've gone sideways from property. So I think if unless anyone else has got any more questions, you ready to call it a night, boys?
Call it.
All right, Brennan, right, shotgun in hand. Yeah, I know. I'm dreading the days my girls bring guys home, but I'm going to have to deal with that one as the mature adult I am. Anyway, thanks for tuning in, guys. It's always great to see you. And Cam at Open Corp for any questions, or shoot through any questions for Ask the Wives. Felicity's here. Felicity, do you want?
And Christian was help at Open
one of the viewers has asked, would you, with Beth and Claire, do a question time on live Facebook? She's saying no. What if we asked some questions and then videoed it separately, and more about the early days when we were investing, those sort of things? She's saying no. She's saying yes, like this.
No.
All right, I'll keep working on that. All right.
So, sorry, Cam. Help at Open Finance.
Help at Open Finance for any finance questions. Leonie's saying yes, Felicity, come on. Help at Open Finance or Cam at Open Corp. If you've got any questions investing, I can point you in the right direction.
Thanks for the show, guys. Thanks, Christian.
Cheers,
Thanks,
gang.
guys.
Always good to see you.